Stocks ripped higher today with the S&P 500 hitting a new all-time high. We did have a bunch of economic data that came out this morning and I will share it with you. But I think one of the biggest stories of all is your first major central bank globally has now started to reduce rates. Yes, the Bank of Canada cut rates this morning, and that paves the way for the US and Europe to start cutting rates as well. And there is something specific that is going on right now in regards to that is really helping our bond market, and that is positive for stocks. Overall, it looks like Tom Lee's call yesterday of a 4% rally for the S&P throughout the month of June doesn't look so crazy. After all, the S&P is up over 1% today alone. First up, according to Goldman Sachs, a flood of cash from passive equity allocations will pour into the stock market in early July, setting up a continued rally through the early summer. Goldman Sachs says the start of Q3 is when a wall of money comes into the equity market quickly. Since 1928, the first 15 days of July have been the best two-week trading period of the year for equities, and they tend to fade after July 17th. The S&P 500 has been positive for 9 straight Julys, posting an average return of 3.7%. The NASDAQ 100 index has an even better record, posting gains in 16 straight Julys with an average return of 4.6%. That's compelling evidence to argue maybe we will get a really strong summer rally. The biggest headwind to markets right now is this perceived narrative that there could be a recession coming, and that's really what has hurt stocks over the past couple of days. You have seen 10-year Treasury yields basically collapse from 4.62% down to 4.29%. Yes, there are reasons why bonds are trading lower today, but the past couple of days, equities have actually been falling on aggregate, and that was based on recession fears. Well, not today. Actually, quite the opposite. First up, you had the ADP employment change, which added 152,000 jobs in the month of May. The expectation was around 175,000 jobs, so not as good as what we were expecting, but still an overall strong number. The service providing sector added 149,000 jobs, mostly trade, transportation, and utilities up 26,000, education and healthcare services up 46,000, financial activities up 28,000, and leisure and hospitality added 12,000 jobs. Now that's pretty unusual because leisure and hospitality tends to be up there towards the top as far as sectors adding the most jobs. This does mean that maybe your Friday's jobs report could come in a little bit on the lighter side. At least that's what Wall Street's saying. This data was important today, but it's really not the reason why stocks are rallying. If anything, this actually adds to some of the recent fears about a slowdown and/or recession. What actually got markets excited today was the ISM Services PMI. Now, you really have to break down these numbers because the headline came in at 53.8. The estimate was 51. So you came in hotter for services in the month of May. ISM Services business activity skyrocketed to 61.2. The estimate was 52.3. So that came in much higher than the estimates and even higher for last month. Last month only came in at 50.9. So that was a big beat, which really pushes back on the whole economy slowing narrative. You have ISM Services employment, which came in slightly on the weaker side, 47.1. The estimate was 48. That kind of lines up to some of the other data that we have been seeing. You have ISM Services new orders that came in at 54.1. The estimate was 53. So that was a little bit better than expected. But you have the ISM Services prices that came in at 58.1. The estimate was 60. So that came in a little bit light. So what does this mean? Just wrapping it all together. Services are doing just fine. The business activity in the service sector, just fine. But prices came down last month. That is your, by definition, soft landing. And this is the data that is really quelling some of those recession fears we've had over the past week or so. So that was very positive for markets today, but you also had the Bank of Canada interest rate decision. Now, I took the liberty to listen to the press conference from the Bank of Canada. And it sounds a lot like what Jerome Powell says. They're going to be cautious. They're going to see what the data looks like. They're going to take things meeting by meeting. But they did kind of put an emphasis on rates are too high. It's too restrictive to bring inflation down this last, step of the way that it needs to go. Now, Canada's PCE or CPI is at about 2.7%, so a little bit lower than ours, and their economy's not as strong as ours. So we're in a little bit different of a camp, but still, that's kind of highlighting where we are right now as well. We're expecting inflation is going to come in very light over the next 2 months. Maybe there is too much restriction on the economy. After all, if you take a look at a stock like Five Below, they've plummeted about 34% in the last quarter heading into their earnings. If you look at a company like Lululemon, they also report earnings today and after hours. They have plummeted about 30% as well. If you basically look at any retail company in the last couple of months, they have not done well, and that's because there are fears that the consumer is really starting to slow down. Different areas, if you look at real estate, we had some pretty bad real estate housing starts that just came out a couple of days ago. Different sectors of the economy are just not doing great. After all, I've been saying this for months here on the channel. Fed Jerome Powell is basically begging for a reason to start cutting rates, and he is, well, I want to say slowly but surely, but pretty quickly here in the last couple of weeks, getting a reason to actually cut rates. Now, also, what the Bank of Canada cutting rates today does is it means that the US now pays a higher rate than Canada, because Canada was at 5% and we are higher than that at about 5.25%. Canada dropped their rates by one cut to 4.75%. That means the spread is now wider between us and Canada. That means if you are a Canadian business or person or whoever you are that wants to, put your money into bonds, now it looks even more attractive to buy US bonds instead of Canadian bonds. So that is also likely fueling some buying pressure in the bond market, in which you probably know this, but when there's buying pressure in bonds, that sends bond prices up and that sends yields lower. And 10-year treasury yields today are falling another 4.5 basis points. You are also expecting to have the ECB, the European Central Bank, lower interest rates by 0.25%, coming tomorrow as well. So it's really going to make our bond markets look very attractive for global investors. You have the Bank of Canada that's starting to cut rates. You're going to have the ECB that is starting to cut rates. Chinese rates are at like 2% or something super low. Japan's at basically nothing, right? And even if there's so many different rates for China. I believe their internal lending rate is 2%, but their actual banking rate is around 5%. But the world really doesn't want to own Chinese bonds anyways, so you can kind of exclude them in that. It really just means the US bond market now is becoming a lot more attractive, and that could help drive down our bonds, even though the Fed over here really hasn't done anything. There is currently a 19.3% chance of the first Fed cut coming July 31st. Now, if 10-year treasury yields continue to fall, that is likely going to boost these odds even more. And I do think coming by CPI next week, coming by more economic data throughout the next, almost 2 months between now and July 31st, you're likely going to have enough confidence to start cutting rates by July 31st. In fact, July 31st is, I would argue, going to be that first cut by the Fed, unless the economy just continues to show a lot of strength again, and it really hasn't been recently, and by the time it looks like you should be cutting rates, you're already too late. And I don't think the Fed wants to make that mistake, being too late to cut rates when they were already too late to start raising rates. And remember, as long as the Fed is cutting rates because the economy is okay, but inflation is falling, that's great. If the Fed is cutting rates because the economy is getting worse or something is breaking, that's when things, or that cut, I should say, is not going to be seen as a good thing. Brian Dietrich over here on X says a 4% or greater monthly gain is fairly rare, but also quite bullish. The S&P 500 higher a year later, 81.3% of the time, and up 12.2% on average. But it just happened in May, which is actually the most bullish month of them all. Higher a year later, 10 for 10, and up 20.1% on average, which again, Tom Lee's call is for a 4% rally in the month of June. So if that happens, it does mean the end of the year is probably going to continue to be strong as well. Bank of America's Savita Subramanian, I probably just butchered the crap out of that, says sell-side indicators at levels suggesting the SPX has a potential to advance 13% over the coming 12 months with a 94% positivity rate. It seems like right now you can really just choose what you want to look at. If you're a bull and you want to look at data that suggests markets are going substantially higher over the next, say, 12 months, I think you can do that. If you want to be a bear and look at data that would suggest we're going into a recession, I think you can do that as well. And I do believe that will lead to a lot of volatility in the next coming months until we get a more definitive picture of what's actually going on with the economy, what the Fed's going to be doing, and how corporate earnings are going to look. But today, the markets are deciding it's a good day. The data was good. Bank of Canada's cutting rates. ECB's expected to cut rates tomorrow. What could go wrong? Tomorrow, you really don't have much of anything. You have exports and imports and the balance of trade. That will move around the estimates for GDP. The current estimate per the Atlanta Fed GDP Now tracker is sitting under 2%. And that's something that some people have been pointing out recently to say, that's not great. Well, we kind of already know that, right? These GDP numbers have kind of been fugazi for a while now. But the Atlanta Fed GDP Now tracker is now at about 1.8% estimated GDP for Q2. And the balance of trade, exports, and imports will move that number as well coming tomorrow. But tomorrow morning, you will also get Challenger job cuts, expecting about 64,000. Not usually a big deal, but in this market environment, we will see. Initial jobless claims also comes out at about 8:30 in the morning, expecting a tick higher from last week's number of 219,000 up to 220,000. But unless we get a big down move or big up move there, it's probably not going to do much of anything. And that's pretty much it for tomorrow. You do have a 4-week and an 8-week bond auction, some PMIs coming out of Canada, and then your ECB press conference at 8:45 in the morning tomorrow. The big data and really what could upset the markets is your non-farm payrolls. Again, you're expecting about 185,000 jobs. The number's probably going to come in closer to about 150,000, maybe even lower than that. Most banks are saying right now, like Goldman Sachs and Bank of America, anything above like 120, 130 is probably okay or probably decent. Decent enough for markets to go higher. Anything under, especially 120,000, 100,000, is where the markets are going to get a little bit more worried and definitely push up those odds of cuts coming sooner by the Fed. But then at that point, you're already in the situation of, is the Fed cutting because we're going into recession, or is the Fed cutting because they feel they can? Which, if we continue to get more bad data, then the markets are not going to like that and stocks are going to sell off. I've also said that for a while now. Bad news, bad data is bad news for stocks. Whether or not markets take it as bad news or not, or when they start taking it as bad news, I never had the answer to that. But it seems like now is when bad news is starting to be seen as bad news. JP Morgan came out with a funny note today. They say, quote, "I want to know where all the hot economy, above trend growth, reaccelerating inflation, high wage growth ticking higher is a given. Rates are not restrictive enough. Fed will not cut rates in 2024. Fed will actually hike this year. People are hiding, while the economy is simply normalizing on all fronts. A quick look at the technicals, especially on the Russell 2000. You did break under that 50-day moving average at one point today. You're back above that. Next major level is around 205.59 when you get above your 20-day moving average. And then you're going to be higher than all of your major or important moving averages once you're above about 205.58 now. Then you can start to make some sizable gains to the upside. And our previous, multi-year high was around 212 on small caps. And honestly, I think we could rally a lot higher than that, maybe to about 220, even 230, if the jobs report comes in around 160, 170, 180,000 along the lines of estimates. I think markets would really like that. As long as wage growth is not too high and you're not seeing other troublesome signs. And also, again, 10-year treasury yields have fallen over 30 basis points in just the last couple of days, and stocks have only been green today. That was it. You haven't seen any love in the markets from 10-year treasury yields actually falling, which is normally what would happen in the last couple of years. If treasuries were to take a move lower, especially a huge move lower like we've seen over the past couple of days, that usually was good for stocks. It hasn't done anything for markets in days. So maybe there is that catch-up effect where you could see quite an aggressive rally in just a short amount of time, because we've kind of ignored this. And S&P 500 is hitting new all-time highs today. I think, again, you just want to watch that 50-day moving average around 517, which is, you're at 534 today, so you're quite a bit off of that. And then you do want to watch your 20-day moving average as well, which is going to be sitting right at about 250, or that would not be good. 526.65, which is basically where you were yesterday. So you're adding a pretty nice gain today. We'll see if we give that back or if we trend sideways or maybe even continue to break out from here. I think it's hard to judge on the technicals. There's not really a lot to look at here. 535, 545, those are levels of resistance potentially to be watching for. But on the downside, really, it's only that 20-day moving average, and then the 50-day, and then the 100-day. We're really in uncharted territories as we are at all-time highs. So let me know what you think about this information down below in the comment section. We do have earnings today and after hours from Lululemon, Five Below, and Victoria's Secret. These are all now heavily discounted retailers. The fear has really crept into these stocks, and we'll see if people are really slowing down. I think these three earnings could be a little bit more important right now, considering the jittery, feelings that investors have about a potential recession that could be coming. So let me know what you think about all of this information down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a great rest of your day, and I will see you in the next one.